All right, so now we are doing a question from another past paper, and let's see that which past paper it is. So it is Advanced Financial Reporting, and this is December 2022. So we are actually doing the practice of the standards. So let's move to the section B, and this is the question number 2 from your section B. And as we know that this is from the standard, so let's see the requirement first. It says briefly explain how lessors must account for the leases within the scope of the IFRS 16 leases. Now for 3 marks, and this is the straightforward treatment. This is the straightforward treatment. And we know the treatment, how the lessors account for the leases within the IFRS 16. I've already provided you with the notes, and you have the notes, and everything is there. So it's a straightforward requirement of writing the treatment. We'll discuss that in a while. Then we have in transaction number 1, so we have 2 transactions in the question. In the transaction number 1, explain how Gabriela PLC must account for the lease contract with Duba in its financial statement for the year to 31st December 2002 in accordance with IFRS, obviously IFRS 16. So transaction number 1, explain how Gabriela PLC must account. So we need to see who is Gabriela PLC. In the C required, says in the transaction number 1, explain how Duba property developers must account for the lease and the property that has been leased out to Gabriela in its financial statement for the year to 31st December in accordance with IFRS 16. So from the requirement, we can see the Duba property developers must account for the lease and the property that has been leased out to Gabriela. So Duba is the lessor and Gabriela is the lessee. So we know how to account for the leases as per IFRS 16, and explain how Gabriela must account for the sale and leaseback of the building in transaction number 2 in accordance with the IFRS framework. And we know that the sale and the leaseback thing is also covered under the IFRS 16. So the complete question is on the leases. The complete question is on the leases. So now we need to read it. So let's read it. Gabriela PLC is a retailer of the fashion clothing with operations spread through Zambia. The directors of the Gabriela seek advice on the accounting treatment of the number of transactions, including the following in the preparation of the financial statements. So they're asking you regarding the accounting treatment. So obviously you should know the accounting treatments before you tell them. So transaction number 1, a lease of the property on 1st January 2022. Remember the year end is 31st December 2022. So on 1st January 2022, Gabriela commenced a 4-year lease of the premises from Duba Property Developers, a company that develops properties for letting out or sell. Gabriela made alteration to the premises on 1st January 2022 in order to meet their use requirements before starting to use the premises at cost of K100,000. Legal fee paid by the Gabriela amounted to K90,000. The lease requires these alterations to be reversed at the end of the lease term and the premises restored to their original state. Gabriela has estimated that the present value of the cost of the restoration is 70,000 after discounting at the rate of the 10%. We know that this is the dismantling cost or the restoration cost or the decommissioning cost. The rental payable by the Gabriela will be K40,000 for the first 2 years and K6,000 for the last 2 years. The director of the Gabriela and Duba are concerned about how the lease must be accounted for in their respective financial statements for the year to 31st December 2022. The interest rate implicit is the 10%. So Gabriela is taking the asset on the lease. Duba is giving the asset on the lease. So Duba is the lessor and Gabriela is the lessee. The property from which Duba has let out the premises to Gabriela was acquired on 1st January 2018. The total cost of K20 million. including K 12.2 million for land. It was last revalued on 31st December at a fair value of K 24 million. DUBA has yet to revalue the property at 31st December 2022, the fair value of K 19, including 1.8 billion for the land. The property has an estimated total life of 30 years. DUBA has uses the IS 40 investment properties cost model in accounting for the investment properties. DUBA uses the IS 16 property plant equipment and revaluation model in accounting for the owner-occupied properties. So this is the transaction number one. So within the transaction number one, Gabriela is leasing the property from DUBA. So DUBA is the lessor, Gabriela is the lessee, and this is a 4-year lease. And in the first 2 years, the lease rentals are, which is due at the end of each year. That means this is the payment in arrears. As we know, there's a different working for payment in arrears and the payment in advance. So this is the payment K 480 in the first 2 years and K 60 for the last 2 years. And we know obviously we need the present value of the lease payments in order to take the opening balance of the lease obligations. In order to take the lease obligations. Okay. And the property from which DUBA has let out the premises was acquired, at a cost of K 20 million, in which the land element is 12.2 million, because the land element is not depreciated, whether it is an IS 16 or IS 40, we never depreciate the land. And obviously, it was last revalued on 31st December to a fair value of K 24 million. They said that DUBA property, a company that develop properties for letting out or sell. So letting out means they are giving the property on the rentals. And when they're giving the property on the rentals, this is their investment property, because any property which we give on the operating lease, that is a rental arrangement, is accounted for under the IS 40. And in the IS 40, they actually account for the property in the cost model. The cost model is same as IS 16. We charge the depreciation, but we never charge the depreciation on the land element, whether it is an IS 16 or IS 40. And it says that the owner-occupied properties that are in the business use are treated at an IS 16. Okay, that is fairly simple. That obviously they are not being let out, and they are not classified as held for sale. So they are actually classified under IS 16, which is the property plant and equipment. So this was the requirement number one, which is the transaction number one. And in the A requirement, it says explain how lessors must account for the lease within the scope of the IFRS 16. Now we know that that when it comes to the lessor accounting, so we know that when it comes to the lessor accounting, so when it comes to the lessor accounting, just a minute, choose the panel. So when it comes to the lessor accounting, as per IFRS 16, and it is also the same as it was in IS 17. So the lessee accounting has been changed in the new IFRS 16. It's not new, obviously. There's so many years now, from 2016 to now. So, but it was the same treatment within IS 17, the previous standard as well. So when it comes to the lessor accounting, we know that the lessor, it is either going to be a finance lease, or either it is going to be an operating lease. So you first need to decide whether the lease is a finance lease or lease is an operating lease. So finance lease or an operating lease. Now, how we decide whether a lease is an operating lease or the finance lease? Now, there were factors based on which we decide, and you need to write these factors within the exam question. There were factors based on which we used to decide whether the lease is an operating lease or the finance lease. And those factors were, for example, whether the present value of the lease payments is approximately equal to the fair value of the asset. If the present value of the lease payment, that means the lease payment which the lessee is making, if you calculate the present value of that, and it is approximately equal to the fair value of the asset, then simply means it is a finance lease. And the other factors were whether the ownership will be transferred to the lessee at the end of the lease period. Ownership at the end of the lease period. If that is the case, then that means it's a finance lease. And when we say it's a finance lease, then this asset belongs to the lessee rather than the lessor. Other factors were, for example, whether it is a purpose-built asset. A purpose-built asset, or you can say a specialized asset, which is made for the lessee. And other than lessee, there is no other use of the asset. There's no other use of the asset. Another, for example, the movement, the gains or losses in the value of the asset belongs to the lessee. The gain and loss in the fair value. If there are gains and losses in the fair value, this gains and losses belongs to the lessee. That, for example, if there's any movement in the value of the asset, it's whether it's a gain or the loss, that belongs to the lessee. And then there were some other points, for example, the secondary lease period, whether the lessee can continue the lease in the secondary lease period, at a reduced or substantially lower rentals. If that is the case, then that is a finance lease. Other points were whether the lease is for the major part of the asset life. Major part of the asset life. If the lease is for the major part of the asset life, then that simply means it's a finance lease. So remember, based on these points, we used to determine whether it is an operating lease or the finance lease. And if it is a finance lease, then the lessee is going to record the asset. And what the lessor is going to record, lessor is going to record a receivable. Like obviously they have given the asset to the lessee, and lessee will record the asset in their financial statements. Lessor will receive the lease payments. So finance lease is just a receivable. The lessor will treat those payments as a receivable. Receivable treated by the lessor. And how it is calculated, it is exactly opposite to the treatment the lessee used to do in their accounting, which was, you know, the recording the right of use and the lease obligations. So lease obligations were actually the present value of the lease payments. The present value of the lease payments. So and those payments were all the payments which the lessee is going to make to the lessor. The same payments which the lessor is going to receive now, we are going to calculate the present value of it. So the same treatment. So this receivable is actually the present value of lease payments, just like the lessee used to record the lease obligations. So for the lessor, it is actually a receivable, an asset, present value of lease payments. And all those payments which were involved in a lease contract. And if you remember from the standard, it used to be, you know, the fixed payments, which are the annual payments, and then variable payments. For example, if the market rentals changes, then there were the residual value guarantees. Then termination penalties. All of these things are mentioned within the notes. And then purchase options. For example, if the lessee will be purchasing the asset by the end of the lease period, purchase options. So all these payments, when you calculate the present value of these payments, you get the receivable. And then the same treatment you used to do, while calculating the lease obligation for the lessee, the same formula: opening balance, we add the interest on implicit rate. Opening balance represents the present value of the lease payments, which are these. So we calculate the present value, and that becomes the opening balance. And then interest on implicit rate. And then we deduct the payments. And the payments are annual lease payments, which are fixed payments. And then you get the closing balance. And remember, we used to do an extra year working in order to split the liability between current and non-current. And because this is the treatment for the lessor, we are going to do an extra year working in order to split the asset between current and non-current. So this is exactly opposite to the treatment of the lessee. So if you somehow forget the treatment, just remember this way, that the lessee's treatment to record the lease is recording the right of use asset and the lease obligation. The working of the lease obligation, if you do the opposite of that, it becomes the lessor accounting for the finance lease. Same payments which we get with the present value in order to get to the opening balance, and we do an extra year working in order to split the asset here, because we have the asset. So in order to split the asset between the non-current asset and the current asset. So the next year balance will be the non-current asset, and the difference between these two balances will be the current asset. So this is the treatment for the finance lease. And first you'd see the factors in order to determine whether the lease is a finance lease or an operating lease. So if it is not a finance lease, then it is going to be an operating lease. So operating lease is actually the other than finance lease. So operating lease is other than finance lease. So how we record the operating lease? So operating lease is actually recorded as rental income Why the rental income? Because in the operating lease, the asset still belongs to the lessor, and they have given the asset on the lease to the lessee, and the asset belongs to the lessor. They have given them on the rent. So in the operating lease, when they have given the asset on the rent and it belongs to the lessor still, then the rental income is recorded. Rental income is recorded on straight line basis. Now, straight line basis in the statement of the profit or loss. That simply means that you're going to record the rent based on the number of months. For example, if you enter into a mid-year lease and only 6 months rental is there, so you do it months by 12. Months by 12. So what are the treatment of the rentals? So obviously debit rent receivable, credit profit or loss. And when the rent is received, debit bank, credit rent receivable. So this is the treatment of the operating lease. So explain how lessors must account for the leases. So lessor either record the lease as a finance lease or as an operating lease. In the finance lease, the asset belongs to the lessee. The lessor will record the lease payments as the receivables. Lease payments as the receivable. And how the lease payments are calculated, I have already told you how it is being calculated. So you will explain all the treatments and also explain the factors in order to determine the lease of the finance lease and operating lease. And then we have this treatment. Okay, so we are done with this. And now we'll go to the requirement. All right, so now we are moving to the requirement number B. It says in the transaction number 1, explain how Gabriela PLC must account for the lease contract with Duba in its financial statement for the year to 31st December in accordance with IFRS. So Gabriela PLC, we know it's a lessee. And the accounting for lessee. So it's a B requirement. Accounting for lessee. We know that the lessee is going to record right of use asset debit and credit lease obligations. So this is the initial double entry they need to make. Now the lease obligations is calculated as present value of all lease payments. Present value of the all lease payments. So we need to calculate the present value of the all lease payments. So which becomes the opening balance. So present value of the all lease payments. So which becomes your opening balance. And then we add the interest on implicit rate. And then we deduct the payments, which are the lease payments, annual lease payments, and we get the closing balance. And what we do is we do an extra year working in order to split the liability between the current and the non-current. So now we need to calculate the present value of the lease payment. So we have year 1, year 2, we have year 3, and we have year 4. So regarding the lease payments, we have the data over here. It says the rental payable by Gabriela due at the end of each year of the lease will be K80,000 for the first 2 years and K600,000 for the last 2 years. So that means obviously we need to, these are the years. And then we have the cash flow. And then we have the discount factor using the interest rate, implicit rate, and then we get the present value. So this is the format. So now we have the year 1. In the year 1, it says that it is 480,000. 480,000. So if we take the working and the 000, so it is 480 in the first 2 years. And in the last 2 years, it is 600. Now we need to calculate the discount factor. How it is calculated? It's 1 plus R raised to power minus N. R is 10%. So 1 plus 0.1 raised to power minus 1. And then in the second year, it's 1 plus 0.1 raised to power minus 2. And then 1 plus 0.1 raised to power minus 3. 1 plus 0.1 raised to power minus 4. So in the exam, obviously you have the table. So you have the table. Yes, this is the table. So you already know that. So you go to the 10%. So the first is 0.909, 0.826, 0.751, 0.683. So these are the given. These are given. So you can just directly put it over there. I just show you how to calculate it. So you can simply just put the figures over here. So discount factor is at the rate of 10%. So it's 0.909, 0.826, 0.751. And then you have 0.683. So now we can calculate, this is the present value. This is which is the opening balance. So whatever is the answer when you calculate it, it becomes your opening balance. And then you multiply the interest of the 10% of the opening balance. And then you have the fixed lease payments. And then you get the closing balance. And this closing balance becomes the opening balance of the next year. This closing balance becomes, so this will be obviously 480. And this you get the closing balance, and this closing balance becomes the opening balance of the next year. And the next year closing balance, this will be your non-current liability. And the difference between these two balances will be your current liability. So this is how you treat the lease obligations. Now we have the right of use asset. So how to calculate the right of use asset? How to calculate the right of use asset? Now the right of use asset is calculated at present value of lease payments, which you calculated from the above working. We add the down payments. Do we have any down payments being made within the equation? Any advance payments? Down payments? No, we don't have any down payments. Okay, so we don't have any down payments. Other things are, for example, we have some other things. We have, in order to meet the use requirement before starting, they spend 100,000. So there is another cost of 100,000. So this is Gabriel made alterations. So this is the cost of alterations. Cost of alterations needs to be capitalized because obviously they spend it on the asset. And it says that the present value of the dismantling cost is K70,000. So there will be a dismantling cost present value. So these three things, when we total, we get the present value. So we have, do we have any other thing? So we have the rental payables, we have the K100,000. Okay, we have another legal fee as well. Yes. We have the legal fee. All the things, just like IS 16, we studied. The cost to bring the asset in the working condition, because it is the right of use asset and non-current asset. So we capitalize all these costs. So this will be the right of use asset. And then you need to calculate what figures will go in the profit or loss. So in the profit or loss, there will be three things with respect to this question. Number one, there will be the depreciation of the right of use asset. Depreciation of right of use asset. Number one. Number two would be the finance cost, which we calculated over here. This one, interest of the 10%. And then we have unwinding of dismantling cost, decommissioning cost, restoration cost, unwinding of the restoration cost. So these three figures will go to the statement of the profit or loss. So this is the answer to the part number B, that how the lessee is going to record the asset. So lessee will record the asset, debit right of use asset, credit lease obligation. This is the initial double entry. The lease obligations are calculated as follows, and then the subsequent treatment is this. And then the right of use asset is initially recorded this amount, and then subsequent treatment is charging the depreciation of the right of use assets. Okay, now the C part is, in transaction number 1, explain how Duba property developers must account for the lease and the property that has been leased out in its financial statements. Now, obviously, we need to decide whether it is a finance lease for Duba or an operating lease. So let's see, are there any factors which we discussed over here? What were those factors? Again, present value of the lease payment is approximately equal to the fair value of the asset. Now, the present value of the lease payment, see, how much is the present value? I guess you said something 1 point something, how much it was. In the 000, just let me just see the chat box. Yes, it is around 1.5 million. It is around, the present value of the lease payment is around 1.5 million. So you see, the total cost of the property is 20 million. So the present value of the asset is nowhere near to the fair value of the asset. So that means the first point didn't meet. Number two, whether the ownership will be transferred to the lessee at the end of the lease period. So the life of the asset is 30 years and they are just leasing it for 4 years. So that means lease is not for the major part of the asset life, and the asset will not be transferred to the lessee at the end of the lease period, and there is no secondary lease periods. And they record the property as investment property. DUBA records the property as IS-40 in their book. So that means this completely shows that this is an operating lease. So you will clearly write that for the lessor, which is the C requirement, the lessor would record this lease arrangement or lease contract as an operating lease. And you will write the reasons, because you see the total life is 30 years and they're just only leasing it for 4 years. And they are recording the asset as per IS-40. So what the treatment will be, they will be just recording the rentals. These treatments will be done. So you can show the double entries to the examiner. So they will record the rentals in the statement of profit or loss on the straight line basis. Okay, then we have the other part, which is the transaction number 2, sale and leaseback. So first of all, let's recall what was in IFRS 16 regarding the sale and leaseback. So it said that whether it is a sale as per IFRS 15, sale, not a sale. Sale means the control is transferred to the buyer and then you have leased it back. Not a sale means that the control is not transferred to the buyer and it is still the asset. So if it is the first scenario, whether the sale and leaseback qualifies the criteria of the sale as per IFRS 15, in that case, the seller lessee will record the right of use asset and the lease obligations, and they will de-recognize the asset from their books. If it is not the sale, then the seller lessee will keep the asset in their books because it is not a sale and they still have the control. Instead, what they will do, they will record the financial liability in their books because they have just taken the loan based on their asset. It is just a financing arrangement. So this is what you need to write in the question. So on 1st January 2022, Gabriel sold a building to a third party at a price of 11 million when the fair value of the building was 15 million. The building, whose estimated total life is 50 years, was acquired on 1st January 2012 at a cost of 10 million. However, Gabriel has entered a contract leasing the building from the new owner for its remaining life of the 40 years at the annual rental of K1.12 million per annum on 31st December each year over the lease term. Gabriel uses the IS-16 property, plant, and equipment model. So you see that they bought this asset in 1st January 2012, 10 years ago, and the remaining life is 50 years because total life is 50 years. Remaining life is 40 years, and they have leased it for another 40 years. So that means this is not a sale as per IFRS 15 because they still have the control of the asset for the rest of the life. So in this case, the treatment is which is the D part, sale does not qualify the criteria as per IFRS 15. Now the seller lessee should still record the carrying amount of asset in the statement of financial position alongside the financial liability as per IFRS 9, as this in substance is a financing arrangement, because the total life of the asset was 50 years. 10 years are already passed. Remaining life is 40 years. And they've leased it back for another 40 years. So this means this is not a sale. They were still having the asset. They were still having the control. Now they have the control as well. So that means they should record the amount they have received as a financial liability. Another indicator is that the fair value of the asset was 15 million. Why they would be selling the asset for 11 million? Obviously, no one is dumb that if the fair value is 15 million, they will be selling the asset for 11 million. So this was another indicator. So the 40-year NVT factor is at 10% is 9.779. So what they need to do is they need to record the working at the amortized cost. So amortized cost is how it works. Opening balance, same working. Add interest, less payment. You get the closing balance. So the opening balance is 11 million because they took the loan of 11 million. Interest rate is 10%. So that means 10% into 11. And the lease payment is 1.12 million every year. 1.12. You get the closing balance. This closing balance is your financial liability, which is a non-current liability. And this is your finance cost in the statement of the profit or loss. So this was the complete questionnaire on the lease, a very easy one. If you know the standards, you would have taken the full marks out of it.